Welcome to Financial Strategies with Andrew Agemy in Connecticut and Daniel Agemy in Colorado.
So, Daniel, I said to the guy, investing in the stock market today is like a game of musical chairs. And when the music stops, somebody's going to be without a chair. I'm Andrew Agemy.
And I'm Daniel Agemy, and you're listening to Financial Strategies. Today we're talking about, is there still risk in investing? And AAA, it does not seem like there's risk in investing anymore. I mean, that's what I hear from all these people, right? I hear markets only go up over time, and I hear S&P as a savings account. I hear things like the S&P might as well be like a long duration bond, all these kinds of things. So is there still risk in investing?
Well, Daniel, that is a great question, and I think we're going to have a lot of fun today because there's a lot of stuff today. I can remember your generation, Daniel, right? Entering the workforce when the great financial crisis happened, and they were stinking scared of the stock market, right? No way could you get them to go into the stock market with their money. But now, you know, that has like turned around where that's where they're putting all their money, right? Or a lot of them are putting a lot of money. Like you say, they're saying, hey, the S&P always goes up. The S&P, like what you just said, it's a savings account. No, it's not. There's risk. And the problem is people are being like ostriches with their head in the sand, right? And not recognizing the risk because they don't know what they don't know. That's why we have the show, right? Financial Strategies, Daniel Agemy, because people don't know what they don't know. And how are they going to know unless somebody educates them? And so we're trying to educate people upon the risk of the stock market because it has such a history of going up over a long period of time that people forget about the in-betweens. And especially when it comes to retirement, you have to pay closer attention. You have to pay different attention to the stock market than when you were 20, 30, 40 years old.
Yeah, absolutely. AAA, so why do people feel that the Magnificent Seven or the stock market is a savings account and that it will just go up? And people do realize it can have little dips, but the Fed is going to step in and push it back up, or there's just too much money for it to come down for any extended period of time. Two questions for you. Do you think that this is new throughout investing history? And second question is, why would you say, you talk to a lot of people, a thing or two, why do you think people have that intuition or that notion?
Oh boy, oh boy, oh boy. So first of all, this is not new. And for those people that have listened to the show, you know my story of in the 90s. I was talking to a guy, stock market is going up, right? 1980, the Dow was at 700. By the year 2000, it was at 11,700. And today it's, pushing 40,000 or something or whatever it is. I don't know, but I lose track. Anyway, the point being is that this guy in the 90s, I'm looking at his portfolio. I'm talking to him about doing financial planning, and he doesn't have essentially any money in the bank. And he's showing me at that time, $25,000 was a lot of money. And he's showing me his mutual fund which is his savings account, in air quotes, right? That has his $25,000 emergency money in it. And I said, well, all this other stuff you have looks okay, but you know, the red flag I see is this money that's in this mutual fund for your emergency money. He said, well, what could happen? Right. And then in 2000, we saw what could happen when the market cut in half by 50%.
58%, right?
Right?
Yeah, 50% in 2008, yeah.
And, well, 2000 was
50%, and 2008 was 58%.
60-ish, right.
Yeah.
So, you know, that, and the point is, the whole point of emergency fund is to be able to have money when you need it. And there's risk to anything we do. There's even risk to being in the bank. The question is, what is the risk and how are you mitigating the risk? And that banking and whatnot is another story, another question, another thing that we have addressed here previously on financial strategies. But nevertheless, the point being here is that you don't put all your eggs in one basket. And if all your eggs are in the market, all your money's in the market, that's very problematic, because we know that most people, they think, well, I have it in this mutual fund, and this mutual fund, and this mutual fund, and they think they're diversifying, but they're truly not diversifying. It's correlated diversification, not uncorrelated diversification, which is it's like the ocean, which is, it doesn't matter if it's the ocean liner, if it's an ocean liner or a rowboat, an old ship, a new ship, a sailboat, a motorboat. It's all, when the tide goes out, they're all going to go down. When the tide goes in, they're all going to come up. Doesn't matter if it's bond funds, doesn't matter if it's global, but mutual fund. It doesn't matter if it's U.S. mutual fund. They're all going to go down when the market goes down. They're all going to come up when the market comes up. And that is very problematic, because if the market is down and you need money, well, then if you're forced to sell it at that point, now you're selling at a lower rate. And the whole thing about investing is buy low, sell high. So you got to be careful about what you're putting in for the future for investing and what you're putting in for savings. And so as far as the question goes, as far as, is this a new thought? No, it's not new. People have been thinking this way. And that was just my personal experience from the 90s to now, right? And now you're experiencing it with what you're seeing. I like to be a student of history, because if you don't know history, you're doomed to repeat it. And there's a lot of people that repeat history, and it's foolishness. It's foolishness. You're listening to Financial Strategies with Andrew and Daniel Agemy. Today's topic is there still risk in the stock market today? And we have a paper that is going to help you to be able to understand some of the risks that we're talking about here a little bit more in detail, in a different way than what we're talking about today. This paper is called Understanding Price to Earning Ratios and PE ratios. PE ratios are a thing that's been around for hundreds of years that people use to understand, is the profit that this thing is paying me worth what I'm paying for it, right? So there's all kinds of markets out there: real estate market, used car market, stock market, fixed income market. The question is, what happens with the market? Market is a place where something is on sale, something's for sale, and how does it get bought or sold? By the buyer thinks it's worth what you're selling it for, and they buy it. Well, this helps you understand if this is really worth being bought. And so we love to put this in your hand so that you can educate yourself and understand it, so you can at least understand the principles, so that you can know what you don't know and be able to make smart decisions on purpose, rather than making decisions by indecisions, which are not wise. So you can have this paper for free by calling us 800-725-7616, 800-725-7616. There's operators on call right now. Understanding price to earning ratios, understanding PE ratios. Call for it, ask for it by name. You listen to Financial Strategies. Daniel Agemy, his father-son team, coming to you to be able to help you know what you don't know, so you can make smart decisions. Daniel, the second question you asked me, is this something new? And no, it's not new. Second question was, why do I think this is occurring? Well, people forget. I said about your generation, right? When your generation entered the workforce, they wouldn't touch the stock market with a 10-foot pole. But they've forgotten about that. And they're investing in the market hand over fist in a lot of ways at this point, which is not necessarily evil or bad, but you just have to balance it and understand it and do it in a smart, wise fashion. So people forget, and that goes back to history, right? That if you don't know history, you're doomed to repeat it. Whether you knew it and you forgot it, or you never knew it to start with, you're still doomed to repeat it, right? But then the other thing is, people get lulled, like the story of how do you boil a frog to death? If you put a frog in boiling water, he's going to jump out of the boiling water. But if you put a frog in lukewarm water and turn that up slowly by slowly, that the more it boils, you're going to boil him to death. He won't even know that the temperature is changing. And that's, unfortunately, what happens. And you know who profits from that when it comes to the stock market and investing? Wall Street. Because they make money if the market goes up, down, or sideways. But whoever's investing only makes it if it goes up.
So nobody can predict when there's going to be a market crash, when we're going to go into a 10-year period of time where there's no growth. And nobody probably should try to do that either. But what you do need to think about, right, is a strategy to protect yourself. So there's a few different, there's all different indicators that we could see if things are cheap or expensive. There's the Buffett indicator, which basically just, it looks at all stocks and it looks at market cap, right? The market cap of all stocks, and it looks at GDP, and it can calculate whether they're expensive or they're cheap. There's sentiment. Sentiment, basically, we just say, are more people bullish? Do more people think there's less risk out there than more, right? And that tends to be, there's price per earning, which you just gave out a paper, a very good paper on understanding another way to measure the value of companies. So we can look at all these different things, and we can see that the stock market in general is very high. We can also look at another thing that people don't talk about a lot, and you look at the discount model. We look at what you can get paid if you just put your money in a treasury bond, right? Compared to historical S&P returns. And it doesn't make them look especially great when you take that risk free. So there's a lot of different things that you can look at. So it doesn't mean you shouldn't have any risk. Right? What it does mean is you should be very careful and understand what type of risk you have. So I think what we've been saying is that, yes, even though if you listen to YouTubers, even if you listen to a lot of financial advisors, even if you listen to all the people that say S&P is like a savings account, there still is risk in investing.
Right.
And you didn't get into it. Hopefully on the next session, you can get into it a little bit, AAA. But there's cycles that markets go through, and they last somewhere around 20 years, right?
Right.
We've seen a lot that lasts 18 years where you have markets just going up for 18 years. And that's a lot for psychology. That's a lot for people to, when you've had 10, 15, 16, 18 years where assets are just going up, you tend to start thinking, this is normal. There's not downturns. I will not lose money, right? 18 years is a long time. So right now, we just happen to be 18 years into an upcycle right now. I'm not using this upcycle. I'm looking at history when I'm talking about 18 years.
Right.
But we just happen to also be in an 18-year cycle right now. Right. I'm not saying that we're going to go 18 years and we're going to have a correction. I'm not saying we're going to go 20 years and we're having a correction. But when we look at history, it makes sense that people start getting lulled into complacency, imagining there's no more risk. And we're going to talk as we go about market flows. We're going to talk about S&P and how it's not the way that it was designed to work. We're going to talk about comparing this Magnificent Seven and S&P to the Nifty 50 of a past generation that just thought those stocks were the best stocks ever and they could never go down.
All right. Well, I see it's time for us to take a break. So you want to come back after break so that you'll be able to hear Daniel and I go through some of these things that he's talking about and how that all works. So in the meantime, we'd love to give you a book. The book's called The Most Important Thing by Howard Marks. And Howard Marks. And Howard Hendricks is a different author. Anyway, Howard Marks, he's got this book that will help you to be able to understand what the most important things are in investing. Get back to principles, get back to fundamentals so that you can make sure that you're moving ahead in the way that you want to move ahead. You listen to Financial Strategies, Andrew and Daniel Agemy. Today's topic is there still risk in investing? And we'd love to put this book in your hand for free by calling us at 800-725-7616, 800-725-7616, because people don't know what people don't know. First 5 first-time callers, 800-725-7616. Call them now. We'll be right back after this.
Financial Strategies with Andrew and Daniel Agemy.
The whole point of investing is to make money. And how do you make money? What do businesses do? What does Walmart do? What do restaurants do? What do gas stations do? What does any business do? Car dealers. They buy low and sell high. That's the premise of investing. Buy low, sell high. You never know. You're never going to sell at the peak on purpose when it comes to the stock market. You're never going to buy at the bottom on purpose. So the key is to buy while it's low and to sell while it's high to reposition. I'm Andrew Agemy.
And I'm Daniel Agemy, and you're listening to Financial Strategies. Today we're talking about, is there still risk in investing? And AAA, we are coming here today to talk about risks in investing people may not have thought of. Now, there's plenty of people that say, that's so silly. Of course there's risk in investing. And then they don't think about what their investments are invested in. Or other people using S&P as a savings account because they think it's that stable and that safe. And there's literally financial people out there saying that all you have to do is put your money in S&P 500 and let it rip. And
let me stop you there for a minute. When you say literally financial people, they're not licensed advisors.
Some of them are.
Right? Oh, some of them are saying that. Well,
it's malpractice, but that's what they're doing.
Right. Well, I know there's a lot of people out there, entertainers especially, right? You know who I'm talking about, where they're giving all kinds of financial advice, but they're not licensed. So they can say anything they want because they're not licensed. But people who are licensed, their feet can be held to the fire because of malpractice. So I didn't realize that we had professional financial people doing it. So go ahead, Daniel.
Yeah, well, so we're 18 years into an upcycle, right? Or depending on how you measure it. If you measure from 2013, which is probably where it should be measured, how many years are we into it? We are into it,
12 years.
12 years.
Yeah.
Into this bull run. But if you started in the business,
right,
at the bottom, you started your career and you've seen 18 years of up. And every time that there was a down, the Fed stepped in to save the day, right?
Right.
So it depends what you're looking at. But so there's bulls and bears.
From that standpoint, if you started in the business at the down, right, you've got a great track record. Your clients are really happy. But you didn't, that's what I said at the very beginning. You didn't do that on purpose necessarily.
Right.
Most people
and you
don't,
probably didn't get in the market because in 2008, in 2009, in 2010, people didn't want to touch stocks with a 10-foot pole. They didn't want to touch the S&P. Right. How many people came into your office from 2008 up until what, 2015, probably, before people started saying, now I can get in. And then 2016, we had the Trump bump and it jumped way up. And after that, people were just like, I gotta be in.
Right. Exactly. It's really a phenomenon, psychology and the human psyche and what people do and how people do things and why they do things. But that's why there needs to be a voice of reason in the world. And that's what you and I see ourselves as, a voice of reason. We're not making people's decisions for us, but we're trying to educate them so they can make smart decisions on purpose rather than indecision, which leads to foolish decisions. Right.
And it's making decisions on purpose. So when we look at the cycles, when we look at market cycles, I can look at the last 100 years and I can see that there is basically 35% or more drawdowns. One of those was 85%.
85%
drawdown. Wow. And one of those was a 60% drawdown. Yeah. So if there's 9 or 10 of those, because some of them were close to 35%. So if there's 9 or 10 of those over the last 100 years, it's basically one every 10 years.
Right.
So if you're okay with that, then by all means, don't pick stocks. Don't go for income and just do what everybody else is doing. If you don't like how that sounds, you need to think outside the box and not think what people are pushing on you, not think what like the big financial media is telling you, because like AAA said,
right,
they're more entertainers, right?
Right.
They're traders. And if you're an investor, if you're investing for your retirement, if you're investing for the long term, especially if you were within 10 years of retirement.
Right. That's the key.
Okay. That's the key. Because if you're 22 years old, you're not going to like, and you're going to be mad when you have a 40% drawdown, but you're going to survive it.
Right.
Okay. And you'll learn your lesson and you'll be wiser for it. But if you're 55 or you're 60 years old, you're not going to be only mad.
70.
You're going to be in big trouble. And if you're 70 or you're 80, you could be it could ruin your retirement.
Well, exactly, because the greatest fear retirees have is running out of money, but they do it because they make one mistake over and over again, which they don't pay attention to to how their money is invested. They keep investing it the way they did when they were 20, 30, and 40, not the way they should when they're older. Just like when you're older, you can't run and play basketball and do all these other physical things the way that you used to do. And you need to do things differently. So anyway, but we're having a good time, Daniel. Time's going by really fast. We got a lot of things to talk about, but I want to, in our listening audience, you're listening to Financial Strategies, and you're Daniel Agemy, this father-son team coming to you to help you know what you don't know. One of the many ways that we do that is by offering you materials to educate yourself, to read, to educate yourself on this besides our podcast radio show. And today we got this paper, Understanding Price to Earning Ratios. This is a paper that's going to be able to help you understand this old principle of analyzing if a company, a stock is worth buying. And you can buy anything that you want, but the question is it worth what you're paying for it? And that's question number one. Question number two is, will it be worth what you pay for or more someday? And the third question is, if it's going to be worth more, is it going to be worth more during your lifetime? Well, if you understand price and earning ratios, you'll be able to understand that a whole lot more. And so we love to be able to put this in your hand by calling us at 800-725-7616 for your free copy. No obligation, no charge, 800-725-7616 for your free copy of Understanding PE Ratios. Call now for that. You listen to Financial Strategies because people don't know what people don't know. So Daniel, let's tell them some things that they don't know, right? One of the things that people don't know is these, you mentioned it, Daniel, these cycles that the stock market goes through. People don't know history. You're doomed to repeat it. And the stock market has certain repeatable trends and predictable trends that happen. They go all the way back to 1792 when the New York Stock Exchange opened, but they're actually calculatable. We can calculate them since about 1899. And so here I'm gonna give you folks in our listening audience some dates. And so basically a full stock market cycle is basically a 30 to 40 year stock market cycle, which is kind of interesting because that's basically the time that people are saving for their retirement. And then they retire, right? After 30 or 40 years. And then you have to do things differently, right? But 30, 40 year cycle, right? So you have the bulls, and a full 30, 40 year market is made up of bulls and bears. Okay? Bulls are when the market's charging like a bull, and bears are like it's sleeping like a bear, hibernating. Okay? From one point to another point, it's not doing anything. So the first example of a bear was 1899 to 1929. It really didn't do, 1921, really didn't do anything. Kind of like slept from one point to another. It's kind of like very often because the stock market, the Dow, the S&P 500 and such was brand new stuff. So it's kind of like when you have an IPO, initial public offering, many times that stock goes for a high price initially and then drops. And it takes a while for it to get back. Many times, I'll say. So But by 1921, the roaring 20s had started kicking in. So 1929, it's roaring. And with that, we had, but you know what happened in 1929? The great crash. And that's when Daniel said the 85% drop was in 1920 with that. And then 1929 to 1954, then another bear cycle, right? 25 years. This bear cycle. It took 25 years for the market to get back to where it was in 1929 and go beyond at that point. You couldn't make money in between there. There were certain stocks doing stuff in there, but not the stock market as a whole, right? So you had to be smart in what you bought and what you sold and what you did. Then 1954 to 1966, we have another bull market where it took off like a bull. The end of World War II, 1946, people, GIs coming back, getting to work. We had 2-income households. The economy took off and everything took off, 54 to 66. Then in 1966, the Dow hit a new high in 1966, midday. It wasn't at the close of 1,000 it hit. And from 1966 to 1982, it didn't go above 1,000 and stay above 1,000 until 1982, when it went above 1,000 and never looked back, right? So then we started, so another bear market was from 66 to 82, in 1982 to 2000, we had another bull market, 18-year bull market, and then in 2000, the market hit 14,000, the Dow hit 14,700, and it dropped 50% by 2002, and it wasn't until 2013 when the market hit that mark again and went beyond it and didn't look back. And now here we are from 2013 to present, and the question is, when's the next bear market coming? Well, we don't know. But we're not as concerned about when the next bear market comes, because we're not going to do a wholesale trade and sell everything that you have and get out, because we never know when it's going to happen. What we're going to use is a strategy. You got to have a good strategy. That's why our company is called Agemy Financial Strategies. It's not called Agemy Financial Investments. It's not called Agemy Financial Group. It's about strategies, because strategies are going to get you to where you need to be, not investments, not group of people. Strategies, the right strategies. And that's what we're talking about, having the strategies that's going to make you money. And I see that we're coming up to break. I've talked all this time, Daniel, and I'm sorry, I'll let you talk next time. So we got to take a break, and we're giving away this book called, what is it called, Daniel?
The Most Important Thing.
Thank you, Daniel. Most Important Thing by Howard Marks. And I got too many things on my computer screens, right? So the most important thing, we got this book. Howard Marks talks about in here. You got to read this book, guys. This is an easy read book. It's not big, but has common sense investing stuff. He talks about in there, have you ever heard about the 6-foot tall guy that drowned in 6-foot tall guy that drowned on 4 feet on average water because he happened to enter where it was 10 feet. And what I just went through is we talked about, we're going to come back and talk a little bit more about those bears and bull cycles, but have this book for free by calling us first 5 first-time callers at 800-725-7616, 800-725-7616 for your free copy. Call now. We'll be right back after this.
Do you have any questions for me about retirement income source?
I just want to make sure I can invest well enough to have enough income, enjoy my retirement.
We build a custom retirement plan based around your income and goals.
How do I know I can trust you?
Building trust does take time, but our investment advisory arm is comprised of fiduciaries, which means our obligation is to you. So you can enjoy your retirement. It's a little more income stability.
I'm in.
That's 2 out of 3.
This is Financial Strategies with Andrew and Daniel Agemy.
AAA, in the 60s and very early 70s, there was this group of stocks. It was considered the go-go years, right? Everything was going. There was money to be made. People were happy. There was stocks that just changing the world. There was 50 stocks, and they were called the Nifty 50, and these stocks were unstoppable. These stocks were amazing. There was no price too high for these stocks, and they were great companies. They're companies that are still around today, right? Companies like IBM, McDonald's, Coca-Cola, Walt Disney, Johnson & Johnson. And the mantra was, they're the best stocks that have ever been and will ever be, and there's no price too high to pay. Well, at that time, the S&P was trading at somewhere around a 19% PE multiple, and these stocks were much higher. They were trading more towards a 40% multiple.
Whoa.
But it didn't matter because they made so much money, and no one could predict anything would ever happen to them. There was no valuation too high. Well, sentiment changed. Things changed. And in 1973, they dropped 19%.
Ooh.
And in 1974, these unstoppable stocks, these stocks that could do no wrong, dropped another 38%.
Oh, no, another 38.
I'm Daniel Agemy.
And I'm Andrew Agemy. Listen, Financial Strategies with Andrew and Daniel Agemy, his father-son team, coming to you to help you know what you don't know. Today's topic, is there still risk in investing in the stock market? Well, Daniel, that is an amazing thing because so people probably don't realize the impact of what you just said. So let me just put it in perspective for people. Okay, so if you have $100,000 invested in those stocks and they dropped 19%, they're down. Your $100,000 is down to, okay, it's grown to 100,000. Your 100,000 is down to $81,000. And then it dropped another 38%. So now it's down, you're down to 50 something thousand dollars. Because it was 33%, 30, what did you say, 30 what? 38?
Yeah, you're down to about 40%. You're down to about $40,000.
Yeah, to $40,000. Your $100,000 went to $40,000. And people don't realize how, if you lose 50% in the market, you have to make 100% just to break even. And in a situation like that, the first year they dropped 19 or 18, and the second year, whatever it was, and then the second year dropped 38%. If that's off of the 19%. So it's not a pretty picture. And how did that happen? How did people lose that kind of money?
Because
and can that happen again?
It's called narrative investing, right? It's called narrative investing. Narrative investing is a thing that happens throughout history. And it's a story that people love telling. It's a story that makes sense to everyone. And so this is the Nifty 50. These are the best companies. Their earnings are so good, they cannot come down. You have to put your money into the Nifty 50.
So they
and it's
did.
a narrative, and everybody gets behind it. Does that sound like any narratives that are right now?
Yeah, this S&P. The S&P doesn't go down. This is what you got to do. You got to get in the S&P, right? Oh, you don't know what to invest in. Invest in S&P.
Seven, right?
Yeah, right. I mean, it sounds so much similar, right? Right now, we got Apple taking off. We got all these NVIDIA. We got all these different things that are doing phenomenal. But, you know, in 20 years, are they going to do phenomenal? And is this, I mean, Apple's been around how many years, Daniel? 25, 30 years?
Yeah.
Public?
Yeah, I'm not sure when it became public. I think it was in the 70s, though. It's been around a long time. It's been growing a long time. But the point is, when you hear these narratives, the Magnificent Seven, what could happen to them? I hear these kinds of things. What could happen to them? Their earnings are so good. We don't know. These companies that were in the Nifty 50 are still around, but look at that kind of drawdown. And so we're not saying that you shouldn't be invested in S&P. We're not saying you shouldn't be invested in Magnificent Seven. But what we are saying is, do you understand the risks you're taking on in these things? And is it closer to the high end when we look at are they more expensive that you should be more cautious? Or as they get more expensive, should you be more aggressive? That's what you got to ask yourself. And a lot of people, and that's what that book we're giving away is all about. It's understanding the risks.
Right.
Typically what happens, same thing happened with the Nifty 50. As they get more expensive, people think they're safer and they put more money into them. So we're a big proponent of being wise. And when you can earn S&P or equity-like returns in fixed income without the same type of risk, why would you not at least take some of the chips off the table and sit back and prepare for better entry points than what you have today?
There you go. Exactly. Well, why wouldn't you? Is because you're not using a strategy. You're going by feeling. You're going by the seat of your pants, whatever the case may be. You're listening to advisors that, maybe haven't been there before, done that, or even know what you know from that standpoint. But you're listening to Financial Strategies, the Andrew Daniel Agemy. You have a paper that we'd like to give you. This one is called TR equals I plus G. It's a formula for successful retirement. Love to put this in your hand. TR, total returns, equals I plus G. We're going to talk about that in a moment or so. But this paper will help educate you so that you know what you don't know to be able to make wise, smart decisions. So we can have that for free by calling us at 800-725-7616. 800-725-7616. Ask for it by name. TR equals I plus G. You listen to Financial Strategies. And your Daniel Agemy. Today's topic is, there still risk in investing in the stock market? Daniel, we've talked about many different things. I started the show with talking about how it's like a game of musical chairs. That's what the stock market is, I feel, right now. And that's what those Nifty 50 that you described did. They went up, and when the music stopped, as far as those companies were concerned, right, there were people that lost a lot of money. And some of those people probably never got back into those stocks again, or if they did, it was much later on after they had proved and came back and proved history and that kind of thing, right? And I'm sure there were those people that did hang on to them through those times, right? So, because there's all kinds of people. But the key, and the thing to think about, ladies and gentlemen, in our listening audience, is the aspect that average is foolish. Earlier, I talked about how a full stock market cycle is 30 to 40 years long, made up of a 15, 20-year bear market, a 15, 20-year bull market. And they say, let's say the S&P 500 does 9.5% over time. Well, during a cycle, if it's 9.5%, it's doing what now? 12, 15%? Well, but during a bear cycle, it's doing 0. So on average, that's how you get the 8 or the 9% or whatever it is. So why would you invest for zero averages, during a bear cycle, when you can still invest? There are other ways to invest that are safer, that are less risky, that you can be more confident in, that are going to bring the money. And that's when we gave out that thing talking about TR equals I plus G. When we're talking about the S&P, many times, the S&P 500, folks, is a growth-oriented portfolio. People think, it's growth. So growth is $10 share, $11 share, $12 share, $13 share. And that's true. But the problem with that can turn into a loss, can turn down, because it can go down to $12 share, $11 share, $10 share, 9, 8, 7, right? And that's a growth portfolio, grown only for the growth of the share price, right? Whereas the I is the income and dividends. And if you looked at an S&P 500 chart that only shows the growth, it's not going to show very good over a 40-year period of time. What gives power to the S&P is the I, the dividends and interest being reinvested. And that's what makes the S&P be so powerful. So that's a good way to invest while you're growing your money, while you're accumulating money. But when you're into retirement or close to retirement, you need to switch to a distribution model. So go from a growth with an income portfolio into an income with a growth portfolio. So its focus is on the income, because in retirement, you need income. And
it's basically backwards, right? So would you rather invest and get your 7% average, so you don't know what's happening, it's just as it happens, it might take 40 years to average out to that 7%, with a 2% dividend to make up your 9%? Or would you rather get your 6% in dividends and your 2% in growth?
Yeah.
Which is still 1% less, but you're certain you're getting the dividends.
Certainty.
right?
Yeah.
You're going
Right.
to collect your 6%. You don't know if you're always going to get the 2%. It's
Right.
just backwards. And so
Right.
at certain points of life, you'd rather have this 6% coming in each year when markets are up, if markets are
Right.
down, if markets are sideways, than having a minus 20% and then a plus 26% and then a flat and then a plus 7 and then a minus 4, right?
Right. Right. Consistency. If you're consistently going up, you don't have to make as much if you're consistently going up. We have many clients who never lose anything when the stock market comes down. And so they make a 0 year. But when the market goes up, they might not make 30% like the stock market, but they might make 10 or 15. But guess what? At the end of the day, they've done it much more confidently with less stress, and they're still well in advance of where they would have been than some of their counterparts. We had a lot of clients in 2008, 2009 that were afraid to tell their friends they didn't lose money because everybody around them saying, oh, I lost money like everybody else. And our clients weren't saying it, but no, they didn't lose money. So yeah, consistency, promises and guarantees are a whole lot better than just plain hope, especially in and close to retirement. So we've got a book that we like to give you today. Another time, today's show's going really fast today, Daniel, but the most important thing by Howard Marks is a book that's easy to read book that will be able to help you focus on what the most important thing is when it comes to investing. And as I had said earlier, the whole key to investing is buy low, sell high. And the question is when and how, right? So we'd love to put this book in your hand to the next 5 first-time callers, 800-725-7616, 800-725-7616 for your free copy. No obligation. Next 5 first-time callers, 800-725-7616. We'll be right back after this. Call now.
The biggest mistake retirees make is not switching from the growth model to the income model. You know, a good retirement plan is having enough income to last the rest of your life. Any problem in retirement, it can be solved with income. The biggest concern that retirees have is running out of money. The second biggest concern is that they want to grow their money so that they don't run out of money. And they think it's synonymous when it's not necessarily the case. People don't know what they don't know. And they're not going to know unless somebody tells them. People think that the only thing that they can do to grow their money is by investing for growth in the stock market. And it's very much a herd mentality. But you can only get growth when the market goes up. When they invest for income, they're able to get money no matter what happens. I'm Andrew Agemy, founder and CEO of Agemy Financial Strategies. We've been helping people enjoy stress-free retirement for over 30 years.
You're locked on to Financial Strategies with Andrew and Daniel Agemy.
So Sally is a client of ours that came in yesterday, as a matter of fact, and Sally bought Apple stock, roughly maybe we'll say $50 a share, really cheap, and it's over $200 a share now. And she has seen this stock go up and up and up and up, and is very concerned about losing that money. Well, Sally decided that she was going to sell some of that and take a capital gain. She has used capital gains on that stock. She sold some of that, took a capital gain. We're doing an analysis to see how much more she can sell, because when she came in yesterday, she's very concerned now with the stock market coming down. Obviously, it hasn't even come down maybe 10% or so, but as far as the market goes, but she's very concerned of what to do with the tariffs and all the things that are happening, and doesn't know what's going to happen, is not happy with President Trump and what President Trump is doing, but nevertheless, and is very concerned and is fretting about this. But the key is buying low, selling high. Sally bought it low, and when she sold it about at the peak, not on purpose, but because it was a smart thing to do. I'm Andrew Agemy.
And I'm Daniel Agemy, and you're listening to Financial Strategies. Today we're talking about, is there risk in the markets? And AAA, as we've talked about, there's a lot of people who have been minimizing the risk, especially in S&P. People talk about stock markets. A lot of people don't know what they're talking about. People talk about stocks, people have a hard time grasping what stock market is. And there's all different indexes, there's all different indices, but basically it's a basket of stocks. And if we talk about S&P basket of stocks, Apple is one of the stocks in that basket, and it's a huge percentage of the S&P 500. And so this basket of 500 stocks has money flowing into it. Who's deciding what that basket of stocks is worth? Not a lot of people, because it's called a flow. Their 401k goes into this basket of stocks automatically, and no one decides if it's a good valuation or not. No one says, I think that this basket of stocks is good value or bad value. All they do is say that there's an algorithm that says, I have money, therefore I must buy. And if no one is selling, right, all markets, there has to be a buyer and a seller.
Right.
And so Sally was a seller towards the high, if not the high, right?
Right.
Sally was a seller. There's not a lot of sellers. So if everyone's 401k is buying Apple and Sally is the only one selling, what does that do to the price?
If everybody's buying and Sally's the only one selling it, it doesn't hurt it.
It pushes it up. Did it go up because somebody said, wow, this is a good company, this is a good valuation, this stock seems like it's making a lot of money compared to the price I'm paying for it? No, it was as simple as more money came into the stock and there wasn't enough sellers, so it drove the price up until
simple as that. Yeah,
people sold. Now, how long can that go on? How ridiculous can a price get before people wake up and say this is ridiculous? Or before something like Nifty 50, people didn't say this got ridiculously priced. Something changed where people didn't want to put as much money into it as was going in before, and it brought it down. Right? That's called the flow, and that's called the liquidity. People think that there's so much liquidity in S&P because you look at the market cap and it's huge.
Right.
But there has to be a buyer and a seller for every transaction. Otherwise, if there's no seller, the price goes up higher until someone will sell.
Yeah.
Right? And that's one risk I never hear people talking about, is what happens if more people want to sell than the buyers? Because for the last, how long has indexing, how long has 401k flows been a big thing? When did those rules change where forced money into the S&P 500? It's been a real big thing since the early 2000s and into the mid 2000s, right? Where 401ks and dollar cost averaging is getting pushed and pushed.
Right. Well, I think that started in the 80s with 401k plans and that kind of thing. And you know my story on that, but which we're not going to get into right now. But Daniel,
in the 80s, they were individual stock pickers, and you could buy mutual funds of individual stock pickers because they beat the S&P. But as the S&P has become the market, and there's no more people investing in individual securities, they just say the market goes up. It created this flow of money, which drives it up. And it's a self-fulfilling prophecy. It always beats individual stock pickers. So therefore, our money must go in, which drives it up, which makes it right, which drives it up, which makes it right. And if you're a student of history, you can believe Andrew and I are full of it, and it's going to keep going up and keep fulfilling the prophecy and keep going up. And then there'll be no money left. All the money will be in S&P 500. And then there's no more money to go into it. Or that there might be some validity to it cannot do this forever. And because it's happening, it's creating opportunities in individual stocks, individual companies that have not benefited the same way as the Magnificent Seven have from these flows.
Yeah, exactly. And that's why we have the paper today that we'd love to give you. Listen, Financial Strategies, Andrew Daniel Agemy. Today's topic is investing in, is there still risk in investing in the stock market? And today we have this paper for you called TR equals I plus G. Total return equals income plus growth. And to get all the total return you need in retirement, that's what you need to be looking for. If you want your retirement to be stress-free, invest for the I more than the G. And so we like to put this paper in your hand for free by calling us 800-725-7616, 800-725-7616 for your free copy. TR equals I plus G. Ask for it by name. Call now. You listen to Financial Strategies. This father and son team coming to you to help you to know what you don't know. Daniel, as you've been talking about all this stuff, one of the things that comes to my mind is I got two words that comes to my mind when you're talking about what you're talking about. And this should be very relatable to the audience that we're speaking to, those who are 50 years old and older listening to us at this point. And those two words are, I believe it's two words. I don't think it's three words, but Cabbage Patch dolls. Cabbage Patch, I believe, is one. Cabbage Patch dolls, right? I think it was the 70s or 80s, right? There's this big craze, Cabbage Patch dolls. You couldn't get a Cabbage Patch doll. And they just became worth more and more. And people were selling them until they weren't. And that's what you're talking about, Daniel. The market is going to keep going up with these flows and keep going up until it doesn't. The music stops, and then what? When all we're wanting people to understand is that there are risks. Calculate your risk, mitigate your risk, and one way to do that is go contrarian. Right, Daniel?
Yeah. And I know that there's people who are saying, Andrew, Daniel, I'm going to wait and I'm going to pull the trigger. Before the markets fall too much, I'm going to get out.
No
way. And I would tell you that there's people that spend hundreds of millions and billions of dollars to get infrastructure so that they can be so quick, so that they can trade within milliseconds.
20 seconds faster.
Billions of dollars. Billions of dollars to get wires or to move their building so it's closer to the stock exchange so that can trade in milliseconds. And I would have to say, are you going to be faster than them? People, there's quant funds. That's all they do. There's traders, there's algorithms. That's all. You're going to be faster than them. That's my question to you. You think you're going to be faster? You think you have more knowledge than them? And so you can try to write it up. You can have play money. You can do different things, but understand the risk. Because in my mind, as people get lulled into saying there's no more risk in markets because it's gone up for 18 years, because it's gone up for 13 years, is where it's the most dangerous and the most risk. And you have to look at your units of risk per units of return. And so if we look at averages, and we've averaged 18% for the last 5 years, and the average is 9%. Do you think that the next 5 years is going to be higher or lower than average? And that's not something we can tell you. I'm not going to predict what it's going to be. But what I do know is when we get to more expensive than less expensive, I look for better value. How many units of risk am I taking on for how many units of return I can get? And if we don't like that metrics, then we look for something that gives us the metrics, or we wait and we're patient until we see metrics that make sense.
Well, Daniel, you're exactly right. And what you're talking about is a customized way of doing things. That most people in our listening audience can't do this for themselves, don't want to do it for themselves. Some of them are smart enough to do it, but they have other interests, right? But that is a key, is customized portfolios, where most people in this world are having what I call the fast food of the financial industry, a McDonald's hamburger for their financial plan, so to speak, right? As opposed to that boutique burger built the way you want it, nice, thick, juicy, mouthwash with the condiments and things that you like on it that fit you. And if you're going with a customized portfolio at less cost than what you're at half the cost of what you're getting from your institutional, your McDonald's hamburger costs, but people don't know what they don't know. And that's why, we're coming to you today, folks, on financial strategy with Daniel Agemy, because people don't know what they don't know. And if you want to understand how you can get a customized portfolio for half the cost of what you're paying for your uncustomized portfolio, call us, contact us today, 800-725-7616. We're going to close out the show with this book.
One thing people may not know is how much you care about retirees, and that when somebody calls in and they want a second opinion, or they want to see what opportunities are available or what they might not know about, they can actually talk to you.
Right.
You're not sending them to somebody else. These people, you actually put time in your calendar to talk to people who are serious about their retirement. And so people may not know they actually can talk to you about their retirement and what they have going on. So I'd like to let the listeners know that, because it's come to my attention that some people think they're going to talk to an 18-year-old or something like that. But they actually get to talk to AAA.
Yeah, and Daniel, it's funny that you say that, because I'll pick up the phone and talk to people, and they'll be like, "Hey, it's just like you're on the radio. Sounds just like the radio." And then people will come in and they'll say, "Hey, where do you record the radio show at? Show me." And it's really kind of funny. So yeah, I enjoy. Good point, Daniel. Good point. Yeah, you want that. You're going to be talking to me at least initially. Sometimes people call up, ask for Daniel, whatnot, but I'm the guy that takes that initial call. Not when you call in, my team sets it up so that we can call, because I'm a very busy guy. I'm willing to give our radio listeners, podcast listeners, time, 15 minutes at least, to find out what's going on, to see if I can lend any value, more value than the show. And then we take it from there. But 800-725-7616 for your free copy of The Most Important Thing, or for talking about how you can get a customized portfolio for you. You've been listening to Financial Strategies, and you're Daniel Agemy. Thank you for listening. And the first 5 first-time callers for that book, The Most Important Thing, 800-725-7616. And until next week, we want your retirement to be stress-free. So invest for the I more than the G.